Qorvo upgraded to buy from neutral at Mizuho. They see that stock positioned well for the upcoming 5G ramp. So apparently do a lot of other investors because that stock was up 85% in 1 year. Could have put this in the earlier conversation.
You bet.
It's all about 5G. It's all about handsets, Apple and Samsung. What do we think about this?
I feel like I already stole my thunder in the A block, but I'm going to say it again. I mean, look, first off, 5G. Sorry, John, I'm coming at you.
No,
I mean, you've been pounding the table on 5G for Apple and others for about a month now. It's already in the stock. So to get this research note, I mean, this is going to cover everything we talked about in the A block. Analysts just piling on now because the stock is going up.
My prior target was 80. I look up today, the stock's at 113. I better get with the train before the train leaves me at the station.
Yep. Well, listen, I'm trimming. I'm not selling outright, but why am I trimming? Well, number one, it's up 40% in 2 months. I mean, come on, you got to show some risk management here. And also, by the way, up 40% in 2 months, that means it's gotten imbalanced anyway. I'm not selling the whole thing. I can say that it's attractively priced, but I can also say that it's ahead of itself and 5G is in it. And in this market, this momentum market, you got to trim your winners and you got to find cheap places to put the money.
That's a good conversation then. Are all of you, we have the wide shot now so I can see all of you at one time. Is the bias on the desk now, has it shifted to what Jim just said? Looking at through your entire book and saying, I'm going to find some opportunities where, Doc, I need to trim some of my winners?
I said it last Friday, Scott, and I'll say it again now, that I think you do have to do that. You do have to rebalance. I mean, I was way too heavy in tech last Friday. And Thursday and Friday, I was an aggressive seller, and I thought it was a gift that we were getting a rising market into that because I anticipated that a lot of people did what I did, held over the new year to see that calendar flip so that they could push taxes out. I think Jim is exactly right to take some profits here. And my core is that I'm really just holding on hard to Apple and to Microsoft, but I've taken off all the calls in those two, except for calls that I've written against stock that I own. And that's how I'm playing it here. In other words, I'm taking some of those chips off the table and waiting for some sort of a pullback because we knew this one was there. It was on the calendar, just like we know JP Morgan Healthcare next week at the Westin St. Francis in San Francisco kicks off. And I'll be taking the healthcare stocks in my portfolio off as they present at that conference.
Aaron?
Yeah, I mean, so semiconductors were up, 65% last year. I think that, and you've seen some of that rally continue throughout the beginning of this year. I think that it is right to take some chips off the table, take a little bit of profits, but I'm not rotating out of the tech sector. I'm rotating within the tech sector. So looking at the software sector, which was up 30%, but it was up a lot. I mean, it was up a lot, but it was up about half the much as the semis. Looking for things that I think have less, sort of robust earnings expectations built in, but still sticking with tech because I think that sector is going to continue to be a winner this year.
I think this is the question that any investor is going to be, not only thinking to themselves, but asking their, financial advisor that very question. Is it time to look through the book and say, I feel a little uneasy about some of these gains, and maybe I need to do what Jim did or Doc did or not?
So what's tough about that is there's always a reason to feel uneasy. And so right now we have a certain set of factors that would make you say, okay, this has gone up this much, this is a risk, or I have X dollars in gain in this one security. I really don't think on an ongoing basis that investors are served by making those types of qualitative decisions just because it goes from December to January or because the Dow goes up, 15% in a given short period of time. So what we do with our wealth management clients is a systematic rebalance twice a year, and neither of those instances take place in January or December. They're not related to the calendar. So that's number one. In terms of individual stocks, you will almost never find a successful investor who's a long-term investor in companies, in businesses, make moves just because it's a particular time of year or the returns for the overall market. So like looking at how the market is done and then saying because the market's done so well, I'm going to have 10% less of this company that I believe in long term. I don't think that works either. So I would hesitate to say that there is catch-all advice for everyone. This is what you should do because the market went up. It's very hard to do that.
I got to run after this point. The other side of the coin is that maybe some of the unease that we're expressing today is misguided. Maybe you sit back, you say, you know what? This isn't going to end like Tom Lee says anytime soon. And there are other targets that are 3,500 and beyond on the S&P. Rates are low, economy's good, earnings are going to improve. Why would I need to get all worried now?
Maybe worried's
Yes.
too strong a word. Maybe saying that there's opportunities ahead. I mean, I personally believe that volatility is going to pick up. We've got some geopolitical tension rising. We've got elections coming up. I don't think we're going to have some bear market. But raising a little bit of dry powder here, trimming things that have gotten imbalanced because they've been tremendous winners, and having some dry powders for a day when things go down and you get everything on sale, I'm okay with that.
Okay.